It's 11:30 in the morning on May 18th, 2012, and the Nasdaq trading floor in Times Square was about to do something it had rehearsed for months. The opening bell for Facebook, the biggest technology IPO to date, the most watched stock market debut since Google, and the system that was supposed to handle it, the matching engine, the order routers, the test runs simulating 40,000 buy and sell orders, was, at that exact moment, breaking. Trading had been delayed 30 minutes already. When it finally opened, more than 30,000 buy and sell orders sat frozen inside the exchange, unmatched and undisplayed, for over 2 hours. The SEC would later call it the largest infrastructure failure an American exchange had experienced in a generation. Nasdaq paid a $10 million fine, the largest ever levied against an exchange at that point. The open loop in this story is the system's fragile seam, the part that handles the single most important second of the entire IPO, the actual trade, is also the part most likely to fail. You probably heard the headline version. Facebook went public. It raised $16 billion. The end of fairy tale. But the real story is the parts that never made it onto CNBC. Because once you understand how a company actually goes public, the bankers, the lawyers, the roadshow, the green shoe, the lockup that strands your early investors for months, you start to see something beneath the celebration that looks more like a controlled detonation. And sometimes, like on that morning in 2012, the detonation isn't as controlled as it's supposed to be. So here's how the money actually moves. Step by step, in the order it actually moves. A few numbers to make this feel real. Facebook priced 421 million shares at $38 each. Total raised across the offering, roughly $16 billion. Implied value of the entire company, set by that pricing, $104 billion for a business that had been private just hours earlier. That day made Facebook, at one stroke, one of the largest US IPOs in recent memory, in the same league as the post-crisis bailouts of industrial giants like General Motors. In the decade that followed, we saw some do even more. Alibaba raised $25 billion in 2014. In 2020, Airbnb raised $3.5 billion in a single night. In 2021, Rivian priced at $78 a share and briefly traded like a company worth close to $100 billion for a startup that had delivered almost no cars. That's the scale, hundreds of billions of dollars moving in one morning. Multiplied across every IPO every year, the system adds up to something staggering. And yet here's the part most people miss. The company raising the money usually walks away with a fraction of what the headlines scream. So where does the rest go? That's the question hiding behind every IPO headline. And understanding the answer is the whole story. Here's the thing, billionaires and fund managers know that the public doesn't. The first number you hear in an IPO, $16 billion raised, is almost always misleading. Because that headline figure counts money paid to early investors and insiders selling their own shares, not just money the company itself receives. Walk through it. When Facebook went public, Mark Zuckerberg sold about 30 million of his own shares, worth roughly $1.1 billion on day one. Many of his earliest employees and venture backers sold alongside him. So a meaningful slice of that famous $16 billion went straight into the pockets of people who already owned the stock, not into Facebook's corporate bank account. Facebook itself only kept what it sold as new shares, primary shares, fresh stock issued specifically to raise capital. This is the secret of the IPO. There are two parallel share sales running at the same time. Primary stock, newly issued, generates real cash for the company. Secondary stock, sold by existing holders, just transfers ownership between private and public hands. Both sides count in the headline. Only one side counts in the treasury. The other thing nobody tells you, this distinction matters because of a number called the gross spread. That's the percentage fee the investment banks charge for running the IPO. In the United States, on most medium-sized deals between roughly $20 million and $100 million, that fee is exactly 7%. 7% of every dollar raised. On Facebook's $16 billion, that's over $1 billion in fees, paid regardless of whether the stock opens up 50% or drops 10% on day one. The 7% number hasn't really moved in decades. It's not a market price. It's a custom. The actual process has 6 distinct stages, and they happen in a fixed order. Stage 1. The bankers. Months before any filing, a private company hires a lead underwriter, sometimes two, rarely more. For Facebook, that was Morgan Stanley. The bank doesn't just earn a fee. It becomes, for a few months, the company's most important advisor, its marketing agent, its pricing strategist, and often its punching bag. The lead bank convenes a syndicate, a group of other banks that help sell the stock to their own clients. The lead bank's reputation is on the line, publicly, in front of every institutional investor on Earth. Stage 2. The S-1. This is a registration statement filed with the Securities and Exchange Commission. Facebook filed theirs on February 1, 2012, 107 days before the IPO traded. The S-1 is the legal document that discloses everything material about the company: financials, risks, executive compensation, lawsuits, related party transactions. It runs hundreds of pages. For Facebook, the first filing alone was over 200 pages. The SEC reviews it. It asks questions. The company amends. It amends again. Stage 2 matters so much because the moment you file, you become an almost public company. There's something called the quiet period. For roughly 25 days before the IPO, executives, insiders, and even rank-and-file employees are restricted in what they can say publicly, lest they be accused of improperly hyping the stock. A wrong tweet from a senior engineer can literally derail an offering. The whole company has to behave, on social media and in public, as if its own IPO doesn't exist. Stage 3. The roadshow. Once the SEC effectively greenlights the marketing effort, executives fly around the world for 10 to 14 days, pitching institutional investors, pension funds, mutual funds, hedge funds. Morgan Stanley sent Zuckerberg through meetings in Boston, New York, London, and Hong Kong. The goal isn't just to sell the stock, it's to gauge demand. Those meetings generate the book, the running tally of how many shares each fund wants, at what price. Stop here for a second. Imagine doing this. You are the CEO of a company you've built for 8 years. You fly first class across 4 continents. You pitch the same story to 50 different rooms of professional buyers who already know more about your business than you do. They ask sharper questions than any board member ever has. And your entire personal net worth is riding on their answer. That's not an exaggeration. That is the actual job description for the 2 weeks of an IPO roadshow. Stage 4. Pricing night. The night before the IPO, the underwriters and the company set the final price. For Facebook, that was May 17, 2012. They settled on $38 per share. The initial range had been $28 to $35. By the time the roadshow ended, demand was so strong they'd upgraded the range to $34 to $38. They went to the top of that range, a 42% increase from the original low end. Fully subscribed, the deal was on. Now here's a question nobody outside the industry bothers to ask. How did all this cost the company anything at all? Here's what people forget. Going public is not free. It's not even remotely free. The 7% gross spread on a $16 billion deal is $1.112 billion paid to the banks. Add in legal fees, drafting the S-1, doing due diligence, negotiating with the SEC, typically several $millions for a deal that size. Add in accounting and audit fees, because the financial statements in the S-1 have to be audited under public company standards before the company even files. Add in printing and distribution costs for the prospectus itself. Physical booklets used to be mailed to every potential investor. Today it's mostly electronic, but the underlying cost structure persists. Then there's the cost nobody talks about, the Sarbanes-Oxley compliance burden. Once you go public, your internal accounting controls have to be documented, tested, and audited every single year. Section 404 compliance alone can cost mid-sized public companies several $millions a year, forever, after the IPO. And the listing fees themselves, NASDAQ and the NYSE charge annual fees based on shares outstanding. They're not enormous per company, but they stack up across a portfolio. Add it all up, just on the day of the IPO, before a single share trades, a typical large-cap IPO costs the company somewhere between 7% and 9% of the total raise in direct costs. Many companies spend more than $50 million just to do the mechanics: the lawyers, the accountants, the printers, the bankers, the listing fee. That's the part that looks fine on paper. Here's where it actually breaks. Here's the impossible part of the system. The whole point of an IPO is the moment when private ownership becomes public, when millions of regular investors, mutual funds, and pension plans can finally buy shares. That moment is the opening trade on listing day. And the opening trade is also the most fragile moment in market infrastructure. Why? Because before the opening bell, the exchange's matching engine has to balance every buy order against every sell order at one price, all at once. There's no precedent trade to look back on. There's no live price to recalibrate against. The system has to estimate the right opening price, line up orders, and execute tens of thousands of trades in a fraction of a second, all while being broadcast live to a global audience. When that fails, and it fails more often than you'd think, the consequences don't stay contained. They cascade into investor confidence, into the country's financial reputation, into whether regulators come calling. On Facebook's day, Nasdaq's system had only been tested against roughly 40,000 simulated orders. Real demand blew past that. More than 30,000 orders got stuck in limbo. The opening bell rang late. By mid-morning, the exchange had assumed a short position of over 3 million shares, trying to keep the market orderly, a position it shouldn't have taken, and one it eventually had to buy back at a loss. This is the structural weak point. Not the bank, not the company, not even the regulator. The wire itself, the actual moment of conversion from private to public, is where the system is most exposed. Break that, and you don't just break one trade. You break faith in the infrastructure for years. Now let's go back to Menlo Park, February 1st, 2012. Zuckerberg signs the S-1. The document goes public. For the first time, anyone with an internet connection can read Facebook's numbers, its risks, and its controversial or embarrassing disclosures, including, in the footnotes, the company's projected growth assumptions, its dependency on Google for hiring talent, and Zuckerberg's voting control of nearly 60% of the company's voting power. The roadshow runs for 2 weeks. Whispers emerge from the meetings. Demand is strong. The price range is set initially at $28 to $35, then upgraded to $34 to $38 as institutional money piles in. May 17, 2012. Pricing night. Morgan Stanley, JP Morgan, Goldman Sachs, and the rest of the syndicate decide. $38 per share. Fully subscribed. The deal is on. May 18, 2012. Listing day. The opening is supposed to happen at 9:30 a.m. It doesn't. Technical glitches at Nasdaq delay trading until 11:30 a.m. When it finally starts, the first trade prints at $42, but the system is already failing. Buyers aren't getting confirmations. Sellers aren't getting fills. Whole brokerages lose visibility into their own positions. The SEC will later determine that more than 30,000 buy and sell orders went unexecuted for over 2 hours. Nasdaq assumes an unauthorized 3 million share short position trying to stabilize the price. By close, Facebook stock finishes at $38.23, just 23 cents above the IPO price. Despite all the chaos, it didn't crash, but it didn't pop either, which itself was a kind of failure. The money left on the table, the gap between the offer price and what the market would actually pay, was effectively zero that day. So far, so uneventful. Then comes the part the headline skipped. 6 months after the IPO, all the insiders, Zuckerberg, his earliest employees, venture capital backers like Peter Thiel and Accel Partners, are still locked up. They legally cannot sell their shares. The lockup period, set at the IPO, was 91 to 180 days for various groups. Zuckerberg himself had agreed not to sell for a full year. August 16, 2012. Hundreds of millions of shares become unlocked in a single day. The float, the pool of stock available to the public, increases by roughly 60%. The price collapses. By mid-August, Facebook trades at 1988s, almost 48% below the IPO price. The bigger-than-Google story is now a punchline on cable news. It took until July 2013, 14 months after listing, for Facebook to recover its $38 IPO price. The company itself, meanwhile, kept doing fine. Revenue kept growing. The product kept working. The cause of the failed IPO had almost nothing to do with Facebook. It had everything to do with the infrastructure, the underwriting relationships, and a market structure that hadn't been seriously stress-tested in years. What changed after 2012? Direct listings. That's when a company goes public without issuing new shares, and without using underwriters in the traditional sense. Spotify did it in 2018. Slack did it in 2019. Coinbase did it in 2021. They saved the 7% fee. They avoided the long lockup. They used the existing private market price as the opening reference. The catch? No bank runs the book, so there's no guaranteed buyer pool, and the opening trade can swing wildly. SPACs, special purpose acquisition companies, exploded from 2020 through 2022. A shell company goes public first, raises money, then merges with a private company to take it public. Hundreds of billions of dollars moved through this structure. Then most of those SPACs collapsed. Many of the companies that went public via SPAC trade today for a fraction of their debut price. More recently, IPO activity has slowed. Higher interest rates, fewer buzzy tech listings. Companies that would have rushed public in 2021 are waiting, or staying private longer, with late-stage rounds at valuations that would have been impossible a decade ago. The headline: the IPO as a celebration is becoming rarer. The IPO as a calculated financial event is becoming the norm. The difference between a great IPO and a bad one is razor thin. Look at the extremes. The bad scenario: Facebook. Day one close at $38.23. Effectively zero first-day pop. Lockup expiration triggering a multi-month decline. Investors who bought on day one were underwater for nearly 15 months. The company itself was fine. The infrastructure failed. The deal makers looked bad. The worst scenario: many SPAC-era listings from 2021, names you'd recognize, now trade at 10%, 20%, even 5% of their IPO prices. Some are below the cash on their own balance sheet. Lockup expired, float exploded, share price imploded, and early retail investors got crushed. The good scenario: Snowflake, September 2020. Priced at $120, opened at $245, closed at $253.93. A 112% first-day pop. Depending on how you measure it, the company left roughly $3.8 billion on the table, meaning the stock traded much higher than the bankers priced it. Sounds great for investors. Sounds like the company sold itself too cheap. Either way, the IPO was a sensation. Snowflake raised $3.36 billion. Its bankers collected full fees. The better scenario: Airbnb, December 2020. Priced at $68. Opened at $146. Closed at $144.71. A 113% pop. The company raised $3.5 billion and emerged with a public market valuation of roughly $86 billion. Demand was so strong, they had to upsize the deal mid-roadshow. The pattern underneath? Huge first-day pops are not accidents. They're calibrated. Bankers leave money on the table on purpose. It's a feature, not a bug, to ensure early investors make money on day one and come back to future deals. The risk? Leave too much, and the company is furious. Leave too little, and the deal looks like Facebook's. There's a narrow corridor where everyone leaves the room roughly satisfied. Most IPOs hit it. Some don't. So why do the biggest banks, Morgan Stanley, Goldman Sachs, JP Morgan, the small club of elite IPO underwriters, keep taking these jobs? The economics look thinner than they used to be. The 7% gross spread hasn't really moved in decades. SPACs cut into traditional IPO volume. Direct listings threaten the model. Regulation keeps tightening. Here's the non-obvious answer. The IPO itself is a loss leader. The real money comes after. Once you're the lead underwriter on a major IPO, you're positioned to win the next 10 years of work for that company. Secondary offerings, debt issuance, M&A advisory, share buybacks, restructuring. Every major capital markets event in that company's life, your bank is at the front of the queue. For Facebook, Morgan Stanley didn't make its real money on May 18, 2012. It made it on every subsequent deal Facebook did over the decade that followed. There's also league table prestige. Lead underwriter rankings drive future mandates. Win the Facebook IPO, you're trusted with the next Snowflake, the next Airbnb. The brand value compounds. Stripped down, banks don't get rich on IPO fees. They get rich on the long tail of every IPO they underwrite. The 7% is the entry fee for a multi-decade relationship. It's 11:30 a.m. on May 18, 2012. The NASDAQ opening bell. The frozen orders. The 30,000 buy and sell instructions stuck inside the matching engine. The thing to keep in mind is that all of it, every layer, every delay, every dollar, was happening inside an infrastructure designed decades ago for a world that looked nothing like ours. The S1 was filed on paper logic from the 1930s. The 7% gross spread is a number that hasn't moved since the 1980s. The lockup rules were written for a market where individual investors had brokerage windows and physical stock certificates. But the actual moment, the opening bell, the matching engine, the orders locked up and unable to find each other, that part was the same system that handles every IPO. Whether it's Facebook at $104 billion, Airbnb at $86 billion, Rivian at $78 with no cars delivered, or some company you've never heard of raising $50 million in a regional listing. And here's the thing. The chaos on May 18th wasn't about Facebook. It wasn't about Zuckerberg or Morgan Stanley or even the SEC. It was about the wire. The thin layer between private and public, where all of human financial ambition has to pass through a single matching engine, on a single morning, in a single second. Going public isn't really about raising money. It's about trust. In the price, in the match, in the system, holding for one long, fragile second. That's the part nobody buys. But it's the part that has to work.